for the first time in a long time, there are actually stocks trading under $20 that are starting to look seriously interesting again. And not just random penny stocks, but companies sitting in sectors that could quietly explode in the next market move. Now, here's the crazy part. These stocks didn't drop because their stories are over. They dropped because the entire market has been shifting, money has been rotating, and fear has been pushing investors to the sidelines. So the real question is, are these low prices a warning sign? Or are they the kind of opportunity that only shows up right before the next big run? Because in this video, we're breaking down 3 specific stocks each from a completely different sector that are not only under $20 right now, but also have some very surprising growth signals behind them. One of them has analysts projecting massive upside despite the recent drop. Another is sitting right at the center of the AI and cybersecurity boom. And the last one is tied to a sector that has already delivered explosive gains, but might still be just getting started. And what makes this even more interesting is the timing. Because while most investors are chasing energy stocks and following the crowd, there's a growing amount of money just sitting on the sidelines, waiting for the right moment to jump back in. And when that money starts moving again, it doesn't go everywhere at once. It flows into specific sectors first. So the question you need to be asking right now is not just what stocks are cheap, but where is the next wave of growth going to happen? Because if you can answer that before the crowd does, that's where the real opportunity is. And that's exactly what we're going to break down today. 3 under the radar stocks, why they've dropped, what's actually happening behind the scenes, and whether this is the kind of setup that smart investors pay attention to before things start to turn. Right now, the market is sending mixed signals, and that's exactly what's confusing most investors. On one side, you're seeing certain sectors, especially energy, continuing to push higher, with money aggressively flowing into oil and gas companies. But on the other side, a lot of sectors that were leading just months ago, like tech, infrastructure, and even cybersecurity, have either stalled or pulled back significantly. And this isn't random. This is what's known as market rotation. It's when big money starts moving out of one area and into another. Not because the original sectors are dead, but because investors are chasing where the short-term growth is strongest. Now here's where it gets interesting. Historically, these rotations don't last forever. At some point, the sectors that were left behind start to look undervalued, and that's when smart money begins quietly positioning itself before the next move. But right now, there's another layer to this story: fear. With global uncertainty, geopolitical tensions, and constant headlines, a lot of investors aren't even rotating. They're stepping out completely. They're moving into cash and sitting on the sidelines, waiting for clarity. And that creates a very unique setup, because when you have large amounts of money waiting on the sidelines, it doesn't disappear, eventually comes back. The only question is where it flows first. And typically, it flows into sectors that are beaten down but still have strong long-term potential. So instead of chasing what's already running, some investors are starting to look at what's been ignored. And that's exactly the kind of environment where stocks under $20, especially in strong sectors, can start to become very interesting again. The first stock sits in a sector that most people aren't even paying attention to right now. And that's exactly why it's interesting. Infrastructure has been one of those long-term growth stories that everyone believed in at the start of the year. There was momentum, optimism, and strong expectations around continued development and spending. But over the last few weeks, that excitement has cooled off. Instead of pushing higher, many infrastructure-related stocks have flatlined or even pulled back, and in some cases, quite sharply. This particular company has dropped more than 20% in a very short period, which naturally raises concerns. When investors see that kind of move, the first reaction is usually to assume something is wrong. And to be fair, there are reasons behind the drop. The company recently reported weaker profitability margins and declining revenue, along with cautious guidance moving forward. In a volatile market, that kind of outlook is enough to scare investors away, at least in the short term. But here's where things start to get interesting again. Despite those concerns, analysts are still maintaining a bullish outlook on the stock. In fact, the projected upside from current levels is significant, suggesting that the recent drop might be more about short-term sentiment than long-term fundamentals. And when you combine that with the broader infrastructure theme, which isn't going away anytime soon, it starts to paint a different picture. Because at the end of the day, infrastructure isn't optional. Whether it's residential or commercial development, the demand for physical building materials remains constant. So the real question isn't whether the sector will grow, it's whether this pullback is creating an entry point before that growth continues. One of the biggest lessons from the current market environment is just how important diversification really is. When everything is going up, it's easy to feel like you don't need it. Investors tend to pile into the same high-performing sectors, chasing momentum and focusing only on what's working right now. But when the market shifts, it always does, that's when the risks of being too concentrated start to show. Take what's been happening recently as an example. Certain sectors, like energy, have been benefiting from global events and rising demand, while others, especially tech and some growth stocks, have taken a hit. And this isn't necessarily because those companies suddenly became bad investments. In many cases, it's simply because investors needed liquidity. When uncertainty rises, they sell what they can sell quickly, and that often means pulling money out of the most liquid and previously overbought stocks. That's why diversification isn't just about spreading your investments, it's about protecting yourself from exactly these kinds of shifts. If all your money is tied up in one sector, especially one that becomes overvalued, you're much more exposed when sentiment changes. But if you're spread across multiple sectors, the impact of those downturns becomes much more manageable. And this is especially important right now because the market is being driven not just by fundamentals, but by external factors like geopolitical tensions and global uncertainty. These events can impact sectors differently and often unpredictably. So having exposure across different areas, whether it's infrastructure, cybersecurity, or defense, can help balance that risk. And in a market like this, that balance can make a significant difference. The second stock comes from a sector that, logically, should be booming right now, but hasn't been performing that way recently, and that's cybersecurity. If you think about it, with the rapid rise of artificial intelligence and increasing digital threats, the need for cybersecurity should be stronger than ever. More technology usually means more vulnerabilities, and more vulnerabilities should mean higher demand for protection. So at first glance, it doesn't make much sense that many cybersecurity stocks have been under pressure. But when you look a little deeper, the situation becomes clearer. A big part of the recent decline comes down to valuation and uncertainty. Many of these companies had strong runs and became expensive, and when the broader market started to pull back, they were among the first to be sold off. At the same time, there's still a lot of uncertainty around how AI will impact the industry. Some investors are questioning whether AI could disrupt traditional cybersecurity models or change how these companies operate. However, there's also a strong counter-argument. Instead of replacing cybersecurity, AI could actually increase the need for it. As technology becomes more advanced, so do the threats, and that creates an environment where companies that can adapt and integrate AI into their solutions may actually become more valuable over time. This particular company has already shown strong growth, with significant increases in recurring revenue. But like many others, it faced a pullback after issuing cautious guidance. So now investors are left trying to balance short-term concerns with long-term potential. And that's what makes this stock interesting. It sits right at the intersection of fear and opportunity. The third stock is probably the most volatile and potentially the most exciting of the three, because it's tied to the drone and defense sector. This is an area that has already seen massive growth, driven by increasing demand for autonomous systems and defense-related technology. Over the past year, many companies in this space have delivered huge returns, which naturally attracted a lot of attention from investors. But recently that momentum has slowed down. In fact, some of these stocks have pulled back by around 20% or more in just a few weeks. And again, this might seem concerning at first, especially for a company that isn't yet profitable. Losses and volatility can make investors nervous, particularly in uncertain market conditions. However, the growth story behind this sector hasn't changed. If anything, it's becoming more relevant. Governments and organizations are continuing to invest heavily in drone technology, not just for defense, but for a wide range of applications. And this particular company has already shown impressive revenue growth, increasing significantly compared to the previous year. The challenge, though, is valuation and risk. After such a massive run-up over 600% in the past year, it's natural for investors to take profits. And when that happens, the pullbacks can be just as aggressive as the gains. Add to that a high level of short interest and lower institutional ownership, and you get a stock that can move very quickly in both directions. So while the potential is there, this is clearly not a low-risk play. It's the kind of stock where the upside could be significant, but so is the volatility. When you step back and look at all three of these stocks together, a clear pattern starts to emerge. Each one represents a different sector, a different type of opportunity, and a different level of risk. The infrastructure stock offers a more stable, long-term growth story, tied to something that will always be needed. The cybersecurity stock sits in a rapidly evolving space, where the future potential is strong but still uncertain. And the drone stock represents high growth with high volatility, where the rewards could be significant, but so are the risks. And that's really what this market is all about right now. Balancing growth and risk. There's no shortage of opportunities, but not all opportunities are equal. Some are safer but slower, while others are faster but far more unpredictable. The key is understanding where each stock fits within that spectrum and how it aligns with your overall strategy. At the same time, timing plays a crucial role. In a volatile market, prices can move quickly, both up and down. What looks like a great opportunity today could face more pressure tomorrow if sentiment shifts again. That's why it's important not just to focus on the potential upside, but also to consider the broader market environment. Because ultimately, these kinds of setup stocks that are down, sectors that are out of favor, and money waiting on the sidelines are often where the next opportunities begin. The challenge is recognizing them before they become obvious. So when you step back and really look at everything we covered, this isn't just about 3 random stocks under $20, it's about understanding where the market might be heading next. Because right now, we're in that phase where fear is high, money is cautious, and most investors are either chasing what's already running or doing nothing at all. But historically, these are the exact moments where the biggest opportunities start forming quietly in the background. Not when everything feels safe, but when things feel uncertain, and that's what makes these 3 stocks interesting. Each one is sitting in a sector that still has a strong long-term story, but has recently been pulled down by short-term pressure. Infrastructure isn't going away. Cybersecurity isn't becoming less important, and the demand for drone and defense technology is only growing. The question isn't whether these sectors have a future. It's whether these pullbacks are creating early positioning opportunities before the next wave of money comes in. Because remember, there is still a lot of cash sitting on the sidelines right now. And when that money starts moving back into the market, it doesn't wait for headlines to confirm everything is safe. It moves ahead of the crowd. It looks for undervalued areas, overlooked sectors, and stocks that have already taken the hit, but still have strong potential. And by the time most people feel comfortable again, a lot of those opportunities are already gone. So now the question shifts to you. Which of these 3 would you actually keep on your watch list? Are you more interested in the stability of infrastructure, the long-term necessity of cybersecurity, or the high-risk, high-reward potential of the drone sector? Let me know in the comments, because I'm really curious to see how you're thinking about this market right now. And if you want to stay ahead of moves like this, make sure you check out the next video where we break down even more stocks that are flying under the radar right now. Because in a market like this, the biggest winners are usually the ones no one is paying attention to until it's too late.